freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here as always with Adam Penn. Hi, Adam.
Hi, Dustin.
How are you?
I am doing great, but I think you have some news to share.
We're supposed to banter. What happened to the banter?
The banter is about you getting your pilot's license.
Oh, yes. Well, that's the
news, not the news article.
Oh, yeah. You see, you just messed me up here.
Okay.
But
tell people about your pilot's license.
That is true. Yes. I'm not sure when this episode will end up airing, but yes, I have just recently earned my not license. I am now a certificated pilot. If we want to get technical, I hate that term, certificated. That's such a government word. But yes, I earned my private pilot certificate. Very excited about that. Been a bit of a journey. It was not something that was on my 2025 bingo card, but had the opportunity to do it and wanted to do that. I took flying lessons. Actually soloed when I was soloed just a couple days after my 16th birthday, and took one lesson after that, and then never flew again for 20 years till this past July. So
the skies were safe for the last 20 years.
They have been safe. Yes, everyone's got to watch out. I'll tell you what, I have learned. I'm definitely I'm very inexperienced. I'm not saying that I have a lot of experience, although I do have 80 hours now. But I have definitely learned that there are a lot other pilots that are more reckless than I am. Let's put it that way. They are.
I don't like when you talk about me like that.
Yeah, I know. It's a bit. You would definitely be one of the. So I fly out of an untowered field here, and it can be a bit of the Wild West in terms of because there's no restrictions, right? Like you don't have to talk on the radio, and you don't really have to follow the rules unless as long as you don't crash into anything or no one reports you. It's not going to be that big of a deal. And there's a lot of people that play fast and loose with how they fly around here. So you gotta be on your toes. That's for sure. Now with that out of the way, that was good banter. Thank you. I'm glad you brought that up. We actually do have a news article that we were going to actually for this particular episode. I thought would go well. I always like being able to bring up these things when if there's stuff that's relevant that shows up in like mainstream financial media, and we can sort of talk about it and share our perspectives. And okay, so this first article, this was in the Wall Street Journal, and I think I've said before on this podcast, I have a love-hate relationship with the Wall Street Journal. I think some things are good, some things are pretty bad. I think they get wrong, but I just thought this was interesting. This was here obviously this article's at the very end of 2025. So some people are thinking about taxes and year-end tax planning. And so of course, Wall Street Journal is like, let's do a personal finance article on this. And so when I saw the headline, don't overlook these little known ways to cut your 2025 taxes, I thought this would I'm like, okay, what are they going to say? And I won't go through the whole article, but we'll for anyone who wants to, we'll have a link to it in the release notes. But I think it's funny that they say little known ways, and then it's, make sure you take the entire SALT deduction and watch out for a Roth
conversion. Which is funny because the subtext up there said other than the SALT deduction.
The new mega bill. Yeah, other than SALT deductions and charitable donations. But the first thing they reference is the expansion of the SALT deduction, which is true, and that's fine. And
so no one's left behind. What does SALT stand for?
State and local taxes. And so this would typically, the big thing for most people is going to be your property taxes. That's usually the big tax bill that gets, or the big tax item that gets included under this. And of course, in high income areas, this was a big thing because it was capped at, what was it, 10 grand or something? It was some fairly low amount. And the new tax bill removed that. We're using the same, the new Trump tax legislation removed that cap. So people that are paying a lot of money in high property tax areas can now, assuming that they are not taking the standard deduction and are itemizing, they can get more credit for that, right?
Which makes sense because it's a tax that's paid. There shouldn't be a limit on it.
Completely agree. I always thought it was kind of weird that there was a limit that was put on that. I think we can argue the political reasons for why that might have been the case, but there's some things here that's talking about how your AGI plays into Roth conversions and things like that. No, we won't dive too deep into this, and I think another one here is required withdrawals from inherited IRAs. Again, I guess this is little known, but it's all still within the bucket of all of the what I'll call standard things, right? Like this is all the Wall Street sort of tax and retirement products. The next item here is maybe taking a larger 529 withdrawal if you've got a 529 plan for education for a child. Talks about the qualified business income deduction expansion and that got expanded out. So, okay, if you have a business and what is it, a Schedule A business, Schedule 1? I always get them confused.
199A.
Yeah. Then maybe you could take a bigger thing here. There's some clean energy provisions that are expiring. I know some people are up in arms about that, especially for buying EVs, but then also for some other things that could qualify for that. But again, the big thing that stuck out to me was that there was nothing really here that I thought was, yes, little known. Maybe it just depends. I think for people who sort of pay attention to this space, there wasn't anything here that was completely unheard of. And again, like I said, it's just all still within that realm of the Wall Street products. And, none of this is really all that esoteric. And, the Wall Street Journal is kind of like positioning this as, oh, hey, here are the secrets that you need to know about if you don't want to pay as much on your taxes. When in reality, there's an entire separate world that...
The rest of the tax code.
Yeah, these are just like tiny, tiny portions. And you've got the rest of the tax code that tells you how to not pay taxes and the things that you can do. And I'll, to give Wall Street Journal credit, that they're obviously this is targeted at most of their audience, and most of their audience are the people that are following the traditional, financial and retirement planning advice and W-2 employees. And
you have to wonder if their advice was different, if their audience would change. Not like the people listening would change, but like if Bob is the one reading it and their advice changed, would Bob do something different?
Yeah, for sure. I don't discount that the audience drives a lot of this, but at the same time, I think it's frustrating for me to know of all of these other arguably better ways. Like if your concern is to like not pay taxes and reduce your tax bill, you don't need to be reading the Wall Street Journal, right? Like you're not going to get what you need from there, because that advice is not tailored to an audience that can do things that step outside of this system. And that's really what you have to do. And it's all the things that we talk about so often on this podcast, right?
I would almost argue that's not stepping outside of the system. It's stepping more into the system, but like deeper trenches of how it works.
Fair point. Yeah. But you have to do the things that are outside of this Wall Street driven system. Yeah. And that, we've talked often, Tom Wheelwright likes to say, if you want to change your tax, you have to change your facts. And that's really what this comes down to. You have to change your facts to where it's so much of what you're doing isn't driven by, again, this Wall Street powered system. And if you start investing in real estate, whether that's, direct real estate ownership and you're buying single family homes, or you're doing syndications or oil and gas, all of the things, again, the tax code is literally a guide for how to not pay taxes. And that's kind of the way to think about it. If you just do the things that it says, then you can not pay taxes. But a lot of times it requires doing things that aren't within this standard Wall Street mainstream financial media bubble. I don't know, Adam. You got anything to add there? This isn't terribly deep, but it's just
to this side probably not. But I think maybe some of this will come back up when we look at the next article.
Okay, we'll go to the next one. This one, interestingly enough, 2 articles on the same day that stuck out to me. This one titled "The Invitation-Only Stock Market for the Wealthy."
Wait. I know that some people are listening and not seeing this, but look at the wallpaper on those walls. Did you notice that?
I haven't. Or would you like to have that wall? That would go well actually there in your background.
It might go well in my background. You get the $1 million, the dollar sign, the ups, the downs. We maybe don't do the downs, but
yeah, I don't know what the random like little 510 and there's
10 million up and above the doorway. So anyway, so I didn't mean to digress there, but I thought that was unique artwork.
It's very unique. I would assume probably AI generated artwork too.
Probably. I don't see any like very weird words, but yeah, probably AI generated. The dollar sign goes over the gold trim. So yeah.
Fair enough. Well, so if you are listening audio only, make sure to pop over to the YouTube version and check out this wallpaper, or just open up this article. I assume it's still going to be there. But yeah, as soon as I saw this headline, I was like, well, I don't really even need to read the article to know what this is going to be about. And I was somewhat right and somewhat wrong. The big driver of this was talking about, we're here in recording this in mid-December, and OpenAI is currently having a $40 billion offering, a private stock offering, where they are selling equity in the business. And basically, you have to be handpicked by their executive team in order to have the opportunity to purchase some of those shares, which is not all that crazy. I thought that it presented a framework that applies and that really is the world that we live in terms of private offerings and what we do. But just to hit a couple things here on that I thought was interesting. It actually says here, fewer than 50 investors snag shares. I don't know, Adam, we talk about our average investment amount. I don't know what 40 billion divided by 50 is, but that's a pretty decent check size. That gives us something to aspire to.
Yeah, about $8 billion a share, 7.5 billion dollars per investor.
Okay. Well, hashtag goals, right?
I don't think they had to handpick those investors. I think they were pretty self-select.
Yeah, there's not a ton of people that could be cutting $8 billion checks. That's a fair point. This is a little bit of an aside, but I did find it interesting. It says, for most Americans, the universe of stocks they can invest in is rapidly shrinking. The number of public companies in the U.S. is half its peak in the late 90s. And it says that's not a problem for the rich. I was unaware of this.
The wealthy don't have their money in stocks.
Correct. And obviously the point this article is trying to make is that they have access to private offerings. Which I don't like, as I think that's the big theme of this article is that, oh, hey, if you are uber wealthy, then you can get access to investment opportunities. In this case, it's really specifically talking about businesses, but in general, investment opportunities that aren't available to everyone else. And it talks about it's creating a two-tier market. One tier is a private club where a privileged group can obtain shares of companies. Some policymakers and economists see this as an existential threat to the U.S. economy.
Well, they shouldn't restrict who can invest in these private placements then.
So there's definitely an argument to be made for that, for sure. That if we want that, instead of continuing to restrict availability to this, to make it more open. But it goes down here. It talks a little bit about the rise of these private offerings, and there's no need to go public. But the big thing, let me get down to it here. Joining the club. To purchase privately held shares, the first barrier of entry is to become what the SEC calls an accredited investor. So what's interesting is, I haven't verified this, but I'm willing to bet that most of these offerings are Reg D, probably 506B offerings, which is the same as SEC registration exemption that we use for real estate and private credit and oil and gas and all of those things. This is exactly the same mechanism that we use to raise money for private offerings. The private offerings that we bring to our investors is the exact same mechanism that's being used here for a $40 billion offering.
Sorry, I know the shares that I have in SpaceX and things of that nature are through a Reg D offering.
So this is, I think I want to draw a little bit of a comparison to what they're talking about here is actually the same thing that is used in much smaller offerings. This isn't just for offerings that are in the billions and billions and billions of dollars. Talks a little bit about how to become the requirements to be a accredited investor. This is interesting. Accredited investors who miss out on a private offering can buy private stocks in the secondary market. Adam, I think that's what you were actually just referring to. You've bought on secondaries, correct? The big thing for this is this article, even from the headline, the invitation-only stock market, or again, painting this whole thing that this world of these private investments and joining the club, that it's some exclusive thing that's only available for people who can cut an $8 billion check. And that's just not the case.
We have a club.
We do have a club. We have an investor club. We would love for anyone listening to join.
And here, this is your invite to the invite-only club.
This is your invite. So you are now no longer excluded from this club. But that's kind of the thing, right? Like, this isn't something that is this space and investing this way is not reserved for the uber wealthy. Again, the people who could cut an $8 billion check. Regular folks, obviously not all of our offerings. Some we do require investors because the SEC requires it to be accredited, and I think that's typically a good threshold anyway. But this is a pretty low bar. They talk about this $1 billion offering and then say, okay, well, you have to have a $1 million net worth or $200,000 annual income. Well, that's kind of a far cry from an $8 billion check, right? So big takeaway from this is, if you see an article like this, it's talking about this invitation-only investments, understand that it's not something that is just reserved for the uber wealthy, and that the types of deals that we talk about and the deals that we want to bring to our investors work exactly the same way. This is not something that is, reserved for only a select, handpicked few. That this is actually a lot more accessible than most people realize. And I think I'm pretty passionate about this because this is the way that this space was presented to me when I was in school earning a finance degree. Is that yes, there was this private investment space, but it was only for the Blackstones and the other family offices and the billionaires and things like that. Millionaires and billionaires. It was only for them, but it's not. This is very accessible to a very large swath of the population. And even again, if it's a 506B offering and you're not an accredited investor, depending on the sponsor, you could potentially still be able to invest in that. So it's.
I mean,
our private investing space is very open. Sorry, Adam, I'll let you talk.
Our last offering was a 506B offering, and we do normally say our average investment size is around $100,000. And we did the math on the last one; it came out to like $99,700 or something. Yeah. So it is, some people invest $50,000, some people invest $200,000, $300,000, $400,000, but on average, it's $100,000 is about what our standard investment is. And so it's not just like if you have $1 million net worth. I had one investor tell me this a while ago. They're like, "Oh, I'm accredited, but I don't want to put $1 million in one deal." It's like, no. That's a requirement, not a requirement that you put all of that into one deal.
I'm glad you brought that up because that is a I think that misunderstanding is a little bit more common than we realize. So yeah, that's a great point.
I think maybe if we want to try to tie these two articles together, right? If you end up on the private alt investment space, and you're looking at what to do, say you buy an apartment building or an oil and gas or something of that nature, and then you pair that with that credit, or not the credit fund, the tax article that is stating that, hey, don't miss out on these what was it? Alternative deductions
little known deductions.
Little known deductions, right? I mean, like we bought an apartment building earlier this year. I think we did an episode on it. It was Cherry Street in Chico. It was a $1.5 million purchase price. Probably said this a few times on the show, but $1.5 million purchase price, about $1 million loan, about $500,000 of equity, and we got a $410,000 deduction in the first year. So that's about 80-something% of the year one investment amount. So for any investor who put $100,000 in that deal, you're going to end up with a $80,000 deduction. That's a little better than trying to write off the property taxes, which also you will get the deduction, the property taxes on that as well. So you're getting that along with any additional expenses incurred by the entity, right? Any other deductions along with it. And then you're getting cash flow from it, right? I think we'll start to kick off some cash early next year and probably be north of 5% in the first year of cash flow.
And that cash flow is, again, this depends a little bit on your own tax situation, how you choose to handle that $80,000 loss, like if you invested $100,000, but that cash flow could potentially be shielded from taxes by that loss.
Yep.
And
yep.
now
or other passive, or depending on your tax situation, but other income this year could be shielded by it, and you could have saved cash this year.
Yeah, and to tie on the tax angle, we have a decent amount of oil and gas offerings. We had one the end of, as we're recording at the end here of 2025. And you want to talk about little known? There's very few people that I talk to that aren't familiar with this space who are familiar with this space who actually know that the extreme tax benefits that are still in the tax code for oil and gas. And not to dive too deep into that, but there you've got you have a passive loss and an active loss, and some of the stuff from the apartments, Adam, you were just talking about, that would be a passive loss. But from oil and gas, that can offset both passive and active. That's an incredible tax benefit. And so, again, you want to talk about little known, like if you have access here to the private club, which is not, I don't think it should be as private or as exclusive as the article made it out to be, then not only do you get a decent investment opportunity, but you get some amazing and very little known tax benefits.
I would say little talked about, probably pretty widely known. I mean, the IDC deductions, I think it's part 469 or 497 of the tax code, something like that. The IDC intangible drilling cost deductions have been around since like 1920. So it's not that there's some newfangled thing that just came around in some bill.
It goes back to the whole thing. You have to change your facts, right? Like if all you're investing in is an IRA and plowing money into a 401k and maybe a 529 or whatever, if it's all in those Wall Street based products, then you really don't have any way to tap into this space. But if you change your facts, you're willing to change the way that you invest and deploy capital in a different way, deploy capital in a way that the tax code says, hey, if you do this, you're going to get to write off a whole lot of this income. You get to take advantage of it. I think it's the main thrust of those two articles. I thought it was interesting that those two appeared in the same day, and I thought they kind of went well together.
Yeah, I agree.
Any other closing thoughts?
I just, it goes back to what we always say, right? You've got to take a little bit of control of what you're doing, right? That doesn't mean being a professional investor 24/7. You can still have your day job, but spend an hour a week thinking about what the next investment's going to be, what you're putting away to it. Look at your finances at the end of every month. It doesn't have to be huge. I just keep a spreadsheet of all the income I've earned every month and where it goes and where it's coming from, just to see how the investments are performing. And you start stacking a bunch of little ones of those, and it starts to pay off.
Well, with that, we'll get on out here. We'll leave links, as I mentioned, to both these articles in the release notes. If you want to check them out, you can do that. And speaking of checking things out, if you check out the review page of Apple Podcasts, or again, whatever you do on Spotify, but leave a 5-star review there. We'd appreciate that. Give us a thumbs up on YouTube and a subscribe, and help give the computers a little bit of a push and know that you like what you're seeing here. We would definitely appreciate that, and we can get this message out to more people. But with that, we'll get out of here for this episode. We appreciate everybody listening. As always, thank you so much. We'll catch you on the next one. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.